Hey everybody, this is Brent from Wolf on Wall Street Trade with a market update for the week ending March 20th, 2020. I've got a lot of stuff to cover, so we'll just jump right into it. Sunday night, the Fed came out with another emergency rate cut. This is 2 days before the FOMC meeting was supposed to start on Tuesday and then have a decision by Wednesday, which we expected this rate cut. So they cut rates 100 basis points, the Fed funds rate. That brings it down to zero, to the 0.25% corridor. Also initiated $700 billion in QE asset purchases, liquidity boosting measures, dollar swap lines with all the major central banks, and cut reserve requirement ratios to zero. So everybody's talking about the Fed breaking out the bazooka. This was like a thermonuclear warhead that they unleashed. And guess what? The market did not care. This is S&P futures, a 5-minute chart. Here's Sunday night. They just sold off. So Dow was down over 1,000 points. They all went limit down, which means they can't trade again until the cash session opens on Monday, and you can see what happened over there. We have limit down, limit up all over the place this week. In last week's video, I showed you that the Fed goes from omnipotent to impotent, and that's what we see when we get into these late cycles and sell-offs and stuff like that. Saw that in the financial crisis, saw that in the dot-com crisis. Everybody that's expecting the Fed to bail out the market in a quick V-shaped bottom recovery, I think they've done 7 in the last week. All of them have flopped. The Fed can get money to banks, but this isn't a financial crisis. They're having problems getting money to corporates and to individual people. So that's really what this is much more about. The New York Fed said that it will conduct 2 repo operations of totaling $1 trillion for the rest of the month. But as you can see on this weekly chart, S&P still down 15% on the week. So I know everybody wants like a forecast or a target. When is this going to turn? Where's the bottom? And people are guessing at it all the time. And you've had people saying buy the dip and buy the V-shaped bottom recovery that's coming, all this stuff. But the fact of the matter is you have to take this as it comes. So Sunday night, I see the futures. I put out a market brief for my subscribers. So as of Sunday night, I said my measured move target would be somewhere around 16% lower, or roughly 21.35. By Monday, because of the price action, I updated my targets. This was my first target. This was Monday over here. So this is my first target, and I had a second deeper target, which is this zone right over here. Just call it roughly 2100, say, to 2150 in there. So you're going to hear me say a lot that I'm not going to predict or forecast this market, but when I have price, like these bear flags, giving me an indication of what is most likely, I will put out those targets. That's what I've been doing. And what my message has been since the start is be careful with indicators. They will give you oversold and they will give you divergences all the way down. At some point, they will be big time right, because at some point the market will turn, but you'll be broke on the way going down because it will give you a lot of signals on the way down. So this is why I don't forecast big targets in advance or where the market might turn or where it might do this or that. It's because this market's moving so fast. It's giving you a lot of good information. And if you're a subscriber to my website, what you'll notice is my analysis is very granular because things are changing by the minute. What I suggest is that you follow the price trend, and it's real easy to do. I can take off these trend lines. When you're in a downtrend, you're making lower highs and lower lows. So let's say this is our high. We have a lower low here. We have a lower high over here. We have a lower low over here, lower high over here, and a lower low over here. That's it. If you're a little more knowledgeable about price action, you see a bear flag like this, you know the probability is that it's going lower. As a matter of fact, this very bear flag is right when Larry Kudlow was saying you should buy these dips. Here's my reaction to that tweet. March 6th, Kudlow says to buy these dips. That's not a dip. That's an ongoing crash. There's the bear flag. There it is breaking down. That is an ongoing crash. That's what price is telling you. Since he made this statement about buying these dips, the S&P is down 22.5% more. By the way, that bear flag was right here, right when it was breaking below the 200-day moving average. These green candles are up days. The S&P has not had 2 consecutive up days in 5 weeks. Traded down and pierced this December low. Market breadth was telling us that this low would eventually be broken way back in here when the market was still rallying, because as the market rallied this whole way, breadth participation got worse and worse and worse every single week. Personally, I didn't think it would happen this quickly. We are still in a downtrend. To get out of this downtrend, we have to make a higher high and a higher low. Then we have a short-term change in trend. Whether it's a long-term change in this trend, you'd need to do a lot more before we get there. But the point I'm getting at is follow the price trend. Price is telling you what it is most likely. There are great opportunities there if you pay attention to what price is telling you. I personally don't call bear markets out being just down 20%. I call it out on a trend being broken, a major primary trend. Here's the 2009 low, and here's the trend. So it's broken. And if we want to adjust this trend line, because everybody draws trends a little bit differently, we can catch the majority of these bottoms and not be exactly on this one. Still broken. The trend is broken. This is a bear market. If we add Fibonacci, you can see blue right through that 38.2% retracement. Here's the Dow Jones Industrial Average. So it was down 17% on the week. It blew well through that 2018 low. Transports actually broke down first, so transports tend to lead the Dow. If you've been watching my videos for a while, then you've probably seen this. You probably remember this, the broadening top formations from 2018, way back here. So 2 years in the making. And I told my members, look, if this acts anything like crude did, which also had the broadening formation, it's going to the bottom. The S&P 500 has one as well. It's down here around 2,100. We'll look at crudes and you'll see what happened with crude. Now the NASDAQ 100 down 12.5% this week, so it acted better. Here's IWM down 15% on the week. There's that 2018 low. Small caps tend to lead the broader market, whether you're trading intraday or long term. I mean, this is what we see. They didn't make a higher high with the rest of the market into 2019, 2020. And at this point, they've taken back everything since Trump was elected over here and then some. Same thing with the Dow transports and then the NYSE. So here is the election. Here's the Trump bump. Taking back everything, trading down. Basically 4 years of gains wiped out in 5 weeks. Getting back to small caps real quick, just the relative performance, I mean, just blown through that 2018 low, down here near 2016 lows. NASDAQ 100 hasn't even touched this 2018 low. I think investors are dumping their secondary stock, but they're still trying to hold those story stocks, the mega caps, the FANGs, all those. That's why NASDAQ 100 is doing better. Anytime I get short, I do it in NASDAQ 100 because typically what happens is it acts better. Investors don't want to give up early in a sell-off. And then usually when you get a second leg, so I would have expected it here, they get more concerned and they dump everything, including those, and they start to underperform on that second leg. That still hasn't happened. So investors, in my opinion, still have not felt max pain or capitulation. I will probably continue to press NASDAQ 100 technology stocks on the downside because I think at some point investors will give up on those stocks. I actually went short once this week, went long once this week. I'll get into that in a minute, but something to show you real quick. This is IWM versus the NASDAQ 100 Thursday and Friday, and it is normalized as of Thursday's open. You can see the better relative performance in small caps. So that's a change in character. One other thing I want to point out, we have a scenario in which we could potentially get an inverse head and shoulders if we make a higher low over here. So that would be a higher low as compared to over here. Inverse head and shoulders, you can almost see kind of the neckline here or the resistance. Now I have to warn, we did have a similar setup over here earlier in the week where it looked like we might get an inverse head and shoulders with a neckline over here, and that failed to a new lower low. There's potential here for a higher low, but we don't have that in place yet. The next thing we'd have to do is make a higher high. Here's the S&P 500. It is still at a slight higher low as of Friday's close, but it's getting very close. I went short earlier in the week in NASDAQ, and I went long later in the week in the S&P 500. I think this was Wednesday. Yeah, this was Wednesday. So I went long right here into the close. The market was rallying a little bit into the close. That's not why I bought it. I bought it because credit markets started to look a little bit better right into the close. Now I held that all through this. Now keep in mind, California completely shut down. 40 million people ordered to stay at home. And I stayed in even after New York shut down. You would think, well, that's bad news. You got to get out. I'm not looking at the news. I'm looking at the price trend. And what I saw was first we had this resistance up here. So it was like, can we make that higher high? If so, I'll hold my long. But what I saw was this little bear flag. And as soon as it started to break down below this bear flag, I got out. So I'd been holding it for a day and a half through all kinds of bad news. But as soon as I saw this, I said, time to get out. Both trades were small gains for about 4% each, but I didn't get run over. I saw some potential, and then when I saw that potential was not holding up anymore, I said, okay, I have no reason to be in this trade anymore. if we did make a higher high, I would hold it and I would let it run until the market told me to get out. So let's look at some S&P sectors, because this is like my first report of the day when the cash market opens anyway. The early update is how are S&P sectors acting. So earlier in the week, what was acting good was the defensive sectors, but they were still in a bearish consolidation. For instance, consumer staples. This is the week, and they consolidated in this trend, but this trend is still a bearish flag. So they were acting better, and the reason I mentioned this earlier in the week was because the last decent bounce we got from the market in the sell-off started with the more defensive stocks leading on the way up, and that was over here, or for the S&P 500 over here. As we got later into the week, the more cyclical sectors started improving. So that was showing overall market improvement. People were taking a little bit more risk, not just the defensive sectors, but the defensive sectors started breaking down, like consumer staples, utilities over here. Healthcare was not a bullish consolidation, but it was a consolidation, and it was doing this most of the week. So later in the week, these defensive sectors that were holding up better started breaking down. The sectors that were getting thrashed, like energy, started to look better. So on Thursday, we had this little bullish ascending triangle. On Friday, it started to break out, and then it failed over here. But it's still a higher low on a very short-term basis. But if you back out and just look at the bigger picture, price action is still essentially a bearish flag. So there's little bits of improvement here and there, but you need to see a lot more improvement for the risk reward to improve for long trades. Here's another one, the technology sector, most influential, most heavily weighted sector. This is about when I got in long. So we were seeing some improvement, a bullish ascending triangle, but we needed to still break out, make that higher high. And on Friday, you can see this triangle failed. So this is how I'm looking at it, very granular, but usually you're going to see improvement on very short-term time frames first, and then you'll see them on longer-term time frames where we can maybe get some traction on the upside. But so far, just to be clear, downtrend, and that means the probabilities are lower. Unfortunately, on networks like CNBC, financial networks, we've been just overwhelmed with people saying, oh, the V-shaped bottom, the V-shaped recovery, but they're not watching what's right in front of them, what's actually happening in price, what price is actually telling them. And as a result, a lot of people have been hurt on the way down. They were saying, buy the dip, and now they've become cautious nibblers. You hear people come on and say, stocks are a value here. Now you have companies that have completely shut down their guidance for the full year. They have no idea what's coming. So how can you say stocks are a value? You can't. Okay, let's skip to volatility. Here's VIX up 14% on the week. Interestingly, it made a high on Wednesday. The stock market fell about another 3.5% or so. Now that's the highest going back to the financial crisis way back here. What I've said generally is for an investor, until VIX is back under 30, this market is uninvestable. In any market, whether it be gold or treasuries, when volatility soars in them, they are uninvestable. They're great for traders. It's very unlikely that the market is going to string together 2 days of gains on the upside until volatility's trend breaks, the short-term trend at least. I have one here and I have one there. And if we take a real close look at it on Thursday, traded in this little bearish flag right between them, broke down. So volatility did break trend. It topped out Wednesday, didn't make any higher highs despite the market making a lower low. And we do have kind of a bearish consolidation here in price for volatility. Here you can see that trend breaking. So this is a minor improvement because you have funds that literally have to sell when volatility goes up. And when volatility comes down, they can leverage up on the long side. So some potential improvement here. If volatility keeps coming down, I may get a little bit more aggressive with my longs when I trade them, when I see opportunities. Not being long the market all the time, not by a far stretch of the imagination. Here's VVIX, so it has a similar trend. You can see up here, probably about 192. And one thing I pointed out to my members earlier in the week, that volatility itself was getting more volatile. So when I see VVIX doing something like this, peeling away from this nice, smooth uptrend, it's telling me we're going to see big oscillations like we did here, kind of broke below the trend, back up, back below. So this is telling me that this trend is likely to break like VIX, at least in the short term. That would be a slight improvement, or let's just say less worse than it has been for the market. Here's the S&P 500 and NYSE 52-week lows over here. This is the October to December 2018 crash, and this is how high they came up. Now, when we were getting this uptrend, forget about the spike over here. when we were getting this uptrend, you should see new lows decreasing on the way up. So at each successive pullback, new lows should be less and less. Instead, they were going higher and higher. That told me that when price tests these levels, it may bounce from there the first time, but it's eventually going to go through. Now, when we had this recent sell-off, well before we hit this 2020 low over here, the lows were already eclipsing what we saw back here in 2018. So that tells me, or told me, that when we get down to this level, price is likely to break that level again. Maybe not on the first try, maybe it bounces there, but it's likely to break that level again. That said, let's zoom in a little bit closer on this, and there is some improvement here in market breadth. Price is going lower. We can see that pretty clearly. But what's happening to these NYSE 52-week lows, the count of them? They're also going lower. So this is some improvement. Notice early in the sell-off, they were ramping higher and higher. This was saying there's a lot of selling pressure. What this is telling us is that the selling pressure is starting to taper off. So you could say that's an improvement in the market breadth this week, or I would rather just say it's less worse than it was. Here's USO for crude oil on the week, 5-minute chart. Down on the week, 29%. This was a horrendous week. Had the worst day ever, down 24%, worst day ever in its history. Then it had the best day ever in its history the very next day, up 23%. But let me just back this chart out a little bit. You can see what kind of a disaster this has been. There it is on an hourly chart. So worst day ever, best day ever, best day ever is not even a drop in the bucket as far as the trend goes. So what we did see last week was a bearish descending triangle. This is a bearish sign. And what I told members was downside target. It's just unthinkable to me. So the downside target from this bearish descending triangle was 32%. And this is why I was just like, that's unthinkable. It can't happen. It did happen. This is the downside target I have. That's 32.75%. Right on the nose. This is what I'm saying. Prices, they're giving us the messages. Even some of these messages are just unthinkable. But so far, they've been dead on. Copper down 14% on the week. This actually was the warning of the sell-off that I was screaming about for weeks, well before the sell-off started. Crude and copper, rates, and currencies were all screaming the same thing. This is the warning. Stocks went up to make new record highs. Interestingly, it seemed like China was defending copper over here to defend their domestic producers. So down again this week. That is basically a big second leg down. Notice the price pattern is the same as we just saw in crude last week, a descending triangle. When you see this bearish descending triangle, until price tells you something different, the probabilities are lower. Take a look at gold real quick. Very, very bullish price trend all the way up here. Notice what happens in here. Gold gets extremely volatile. So I'm going to zoom in on this area. So we go from bullish consolidation, a long one, 5 months or so, bullish consolidation, breakout, another very bullish consolidation, and breakout over here. But look what starts to happen, the volatility in gold. And this is the same thing I was talking about with stocks, with treasuries. When volatility acts up, this is not an investable asset. Here's gold's volatility. And notice when gold started acting really bad. It was the same time volatility broke out around the 24th or so of February. So at first I was looking for gold to hold this trend. It didn't. It broke down. And my next trend I'm looking for it to hold is over here. So that's about 133 or so. I did see gold a couple of days this week looking a little bit better, but we're talking about, for hours or so. We're not talking about a major change in character. I would think that if gold came down a little bit more, it would give volatility some time to come down. But what's happening right now is investors are just dumping everything. They're getting margin calls on stocks, and they're taking their profitable positions in bonds and gold, selling that to meet those margin calls. Another major problem, this is what the Fed is trying to address, is dollar illiquidity. There is a grab for dollars all over the world. So that's why you're seeing the dollar spike up like this. This is just an unheard of move for the dollar. It's insane. This is part of what is weighing on gold as well, the dollar spiking up like this. Let me take you back to the financial crisis. This is 2007, 2008, S&P-500. This is the Lehman crisis, the kind of the worst part of the financial crisis. That's right around here, September, October of 2008. Watch what the dollar does. The dollar soars. This almost always happens when you get into a financial type crisis. There's dollar illiquidity. The dollar tends to soar. And now let's take a look at what happened to gold. Gold got hit. Now if we move forward a little bit, and this is the Fed's job right now, they're trying to meet that demand for dollars. So we'll walk this forward. Finally, they do. The dollar breaks, and this is where gold eventually breaks out and shines. So is that the exact blueprint for now? Who knows? But this is something to be aware of. It's kind of common to see actually during a financial crisis or a bear market, a sell-off like this. TLT actually has a very similar chart to gold. This bullish price action that we've seen since 2018, the end of 2018, going up, consolidating in bullish flags, pennants, stuff like that, keeps on going up. And we saw that same kind of volatility that gold saw over here. And what's preceded all that nasty activity in treasuries, and there's the whole bailout thing, there's the helicopter money, all that, what the Fed's doing with rates, there's all that. But what preceded that was a breakout in volatility. This is a volatility of the long end TY VIX. So you can see the same thing, just like gold. When volatility picks up, the standard deviation of outcomes widens. That's why I've been saying when there's high volatility, these are not investable assets. They're great to trade. So if we zoom in over here on TLT, what I can tell you is it has made two virtually equal legs down. There's the first in consolidation, there's the second. So it did meet the price target. Does that mean it suddenly improves and it keeps on going higher? I don't know, but this is the most dangerous part of the market. For all the hedge funds, the macro funds, all that stuff, when volatility goes up, that's part of their risk management. They have to sell assets. So we're seeing volatility going up in bonds, in gold. They're starting to look like stocks. So these funds sell all those assets just as part of their risk management. The safe havens like Treasury and gold are no longer safe. They become highly correlated to stocks. So here's the S&P-500 in red and green candlesticks, and this is gold in white, and this is TLT in blue. Now, if I show you what their normal correlation is, let me just back out. Markets going down, they're going up. But the last 2 weeks, they've been highly correlated, selling off with stocks. And this is the most disastrous part of a market for people because most people are invested in bonds and stocks and have a little bit of gold. So when bonds are selling off too, portfolios have no way to hedge their equity risk. So where do they go? The US dollar. They go to cash. Last week, some people asked me about Bitcoin. I said, I don't know anything about Bitcoin, but this GBTC, it looks like it's worth a try over here at $5 at this trend line. So it hit that trend line this week, $5.01. And that was Monday morning. So again, I don't know a lot about Bitcoin at all, but this is what I would do as far as a stop. I would connect these lows, follow the trend. This is a little minor uptrend, and that stop right now would be somewhere around 615, 612, something like that. This gain is 59% on an intraday basis, and it's about 26% on a closing basis. So this video is getting real long. Let's wrap it up with a little bit of perspective because we have one of the worst crashes that the stock market's seen in history. It's right up there with 87 and 29. Let me show you how 1987 went because recently there have been a lot of people talking about the V-shaped bottom, and if you bought the day after the crash, you made a whole bunch of money. Let me show you something real quick. Here's the Dow and the crash of 1987. All right, so at what point during the crash? If you bought over here, you got killed. If you bought over here, you got killed. If you waited a couple months, markets usually after a crash like this will retest the low. So you could have bought back here for just 6% more than the low over here. Here's 1929. I'm just going to walk this chart forward. Buy the dip, buy the dip, buy the dip, right? Great opportunity. Crash. And then we got a pretty good counter trend rally. These are what I call sucker rallies. So this looks similar to 1987. We didn't get a big test of the low. This was a suckers rally. And we just continued down from there. This was a 90% loss. So I have to say the one difference between 1987 and now, or even 1987 and back here to 1929, 1932, is that the U.S. did not enter a recession. October of 1987, this is the 3-month, 10-year yield curve. It wasn't inverted. If you watch my videos on YouTube over the last year or so, I've been saying this for this entire time, and to my members, the danger is first when yield curves invert. We saw that over here. But that is just a warning. This is the market already pricing in a recession. This was almost a year ago, well before coronavirus. What is deadly, and this is recession shading in gray, is the steepening afterward. Just about every time, inversion, steepening, recession, inversion, steepening, steepening, recession, inversion, steepening, recession, inversion, and this is what we're doing right now, steepening. The one thing I never said on these YouTube videos was why the yield curve steepened so much, because I figured people are not going to be able to hear this right now. Here's a closer look at that yield curve, and this is February 28th. See how sharply it steepened? The reason why yield curve steepened so much is because the Federal Reserve is throwing the kitchen sink at the market and the economy in terms of easing. So if I had said this a year ago and I said, the Fed is going to come in with $700 billion in QE, they're going to cut rates down to zero, everybody would be like, that's super bullish. How could the market possibly go down? Because they just did a little bit the last couple of months and the market's gone up to new highs. As I showed in my last weekend's video, central banks become impotent at this stage in the cycle. And that's what we're seeing right now. Fed has done 7 things in the last week and the market hasn't rallied on any of them. And that's the one thing we didn't have here in 1987 was the economy was not going into recession. I still think there's a high probability, like 1929, after we get this initial crash, that we do get a suckers rally. And this was a big one, 50%, right? So if you saw a crash and then a 50% rally in several months, you'd feel pretty good too about buying back in. This is why it's called a suckers rally or counter trend rally. Counter trend means it did not make a new high, a higher high. And you know what happened next. Here's that suckers rally. And this is a horrendous bear market, lost 90% of the Dow's value. Of course, this wasn't just a recession, this was a depression. I have to be honest, the last few videos I've been struggling because I don't want to sound like an alarmist and raise, these red flags. Like last weekend, I put these pictures in the video of empty cruise ships, empty airports, empty restaurants. And I thought, maybe I shouldn't do that because maybe it's just too alarmist. 2 days later, all that stuff was true. This is happening at light speed, and the market's trying to discount this in real time. I always base my analysis on actual evidence, something I can show you on a chart, but my thoughts are that this is far, far, far from over. I know people want certainty, and they want, somebody to say, well, the S&P is going to stop here, or this is going to be a V-shaped bottom, or this or that. Nobody knows that stuff. Nobody knows that. My job is not to project targets into the future. My job is to pay attention to what's happening right now, listening to the message of the market. When we first saw trouble in this market was January 16th and January 17th, way back here. Go back and look at my videos for weeks and weeks before this crash started. This was what I was talking about, what I was screaming about, and it wasn't my impression of what could happen. It wasn't a prediction. This is what the market looked like. This is the S&P at all-time record highs on February 6th. This is crude, this is copper, commodities, rates, everything was screaming something really bad was coming. I have certain areas that I'm watching, like, this broadening formation in the S&P-500 around 2100. So that's an area I'm watching. I'm not saying, look, it's going to go straight there, but I think it's going there eventually. And if it acts anything like other broadening formations like the Dow, or more specifically crude, which started as a broadening formation, I first picked up on back here in November. Broadening formation did the same thing as the major averages, moved above, and look how it respected this trend line. So it still mattered. And then when it broke down, came right down to the bottom in bearish flags, bearish trade, just like the Dow is now at the bottom of that broadening formation. And this is what happened since then. My job is not to forecast what's going to happen, where the S&P is finally going to stop. My job is to recognize when price action is telling me a change is coming and then assess that opportunity. That's what I do all day, every day for my subscribers. So with that said, I'm going to wrap this up. Just be aware, like next week, we're going to have initial claims. On Thursday, people never pay attention to initial claims while we're in a bull market. When we're in a bear market, that's all they're going to pay attention to, and they are going to spike. I wouldn't be surprised if they're in the millions next week, but the week after that, they're going to be even worse, and I think these numbers are going to be so stunning, the market is probably going to react to them. So it's just a little data point that we haven't paid attention to in years that comes up on the Thursdays, and it's something to be watching. So we have a little bit of improvement in a few areas. Volatility is starting to break trend a little bit. Saw some flashes of credit looking better here and there for brief moments. We saw small caps leading a couple times this week. We saw some cyclical sectors acting better. So these are all changes in character, and changes in character precede changes in trend. If we do get one of those 1929 kind of bounces, I'm going to be selling it. But if I can, I'm also going to trade it on the long side as well. But my first priority is always getting this information out to my subscribers. And if a trade interferes with that, I don't take the trade. So if you like the video, please give it a thumbs up. If you feel like there's somebody that might benefit from it, please feel free to share it. I started doing these videos just for my own subscribers at Wolf on Wall Street Trade, and more people have seen them on YouTube, but I really don't have that many YouTube followers. And I wish we could have gotten this message out to more people before we got this kind of economic pain. If you have questions or comments, please leave them in the comment section. And if you're interested in subscribing to my service, and what I do is just put out between 6 and 12 updates a day, looking for opportunities, assessing risk and reward. Okay, enjoy the rest of your weekend. Stay safe, everybody. Members, I'll see you on Monday, or if there's an update that needs to come out on Sunday night, I will do that on Sunday night, as we have the last couple of weeks. Take care, everyone. Stay safe.